How do rising interest rates impact the national debt and deficit? Imagine a household that has taken out a loan to buy a home. As interest rates rise, the monthly payments on that loan become more expensive. This scenario is similar to what happens at the national level when interest rates increase. The government borrows money to fund various programs and services, and when interest rates go up, the cost of servicing that debt also rises. When the government issues bonds to finance its operations, it pays interest to bondholders. If interest rates increase, the government must offer higher interest rates on new bonds to attract investors. This means that the cost of borrowing increases, leading to higher interest payments on the existing national debt. As a result, a larger portion of the government's budget may need to be allocated to paying interest rather than funding essential services like education, health care, and infrastructure. Additionally, rising interest rates can slow down economic growth. Higher borrowing costs for businesses and consumers can lead to reduced spending and investment. When economic growth slows, tax revenues may decline, which can widen the deficit. A larger deficit means that the government needs to borrow even more money, further increasing the national debt. It's also important to consider the impact on inflation. Higher interest rates are often used as a tool to combat inflation, but if inflation persists, it can erode the purchasing power of consumers and lead to economic uncertainty. This uncertainty can affect government revenues and spending, complicating the management of the national debt and deficit. In summary, rising interest rates can lead to increased costs for servicing national debt, potentially widening the deficit and impacting overall economic growth. Understanding this relationship is essential for grasping the broader economic implications of monetary policy decisions.